always exist between the auditor and management of the company that's under audit. Right? Trust but verify. Have a question in mind. Right? So we don't want to assume that management is dishonest, but we don't want to assume total honesty either, right? It's trust, that's the idea of trust but verify. All right, let's look at another one. So the correct answer is C. Remember what we said about professional skepticism? Questioning, right? So you want to critically assess the evidence that is provided. And so what you have, right, so let's just kind of go through with A, rely more extensively on external evidence rather than internal evidence. That presumes that external evidence you don't have to be skeptical about, right? You have to bring skepticism to the audit in general. It's not just about the evidence that you're, you have to, whether the evidence is external or internal, right? So for example, here's external evidence. You get external evidence from a third-party specialist, right? And they provide the auditor with information. Right? And that information that they provide the auditor with is around estimates. Right? So auditors still have to evaluate the assumptions that we use, the inputs, right? Does it make sense? And that's external evidence. So it's not a matter of external rather than internal evidence. You focus on more than quantitative items in the financial statements. As we go through the rest of the semester, you'll see there are a number of qualitative issues that the auditor, or qualitative information that the auditor has to assess in evaluating the client and evaluating the financial statement. So it's not just focusing on quantitative information. So critically assessing verbal evidence received from the entity's management. So one of the things about verbal evidence, right, is that the auditor, this is management's opinion or management's explanation for something. So that's going to be even more important for auditors to critically assess that evidence, have a question in mind. Right? Think about alternatives, reasonable alternatives, not just look to confirm what the client told you. Yes, Stephanie.
But aren't you also assessing like what's on the document and what are on like their internal statements? Right,
you are. But so for example, the client, there's some things that you're not going to have documents for necessarily. Not all, because you have to, so clients have to explain it to the documents, right? They have to, so let's say the client gives you their calculation, how they came up with the allowance for doubtful accounts, right? So that's not a matter of just calculating, the client's, how they got there. It's thinking about, is it reasonable, the assumptions they used to get there, right? And that's questioning management. Why did you, what's your basis for reserving 75% of receivables over 120? Why not 100%? And what's your basis for that? Like, you're challenging management's assumptions, right? And because they're going to explain that. You're not going to get a piece of paper that says, this is why we chose 75% necessarily. Right?
Okay.
So there's uncertainty, and that's why. And so usually in those types of issues where there's a lot more uncertainty, you have to, you start with management's basis for how they arrived at those numbers or their decisions. And so evaluating potential financial interests held by auditors and the client, as we will see, is a violation of independence. And so that has nothing to do with professional skepticism. That is looking at whether or not the auditor meets the standards, auditing standards, right? That they haven't impaired their independence because they are not allowed to have a financial interest in the client. Right? So the correct answer is all right, so let's talk about generally accepted auditing standards. So the first thing I want to point out is generally accepted auditing standards apply for auditors, whether they're auditing publicly held companies or whether or not they're auditing privately held companies. Right? It's the standards that guide the conduct of the audit. And so what we're going to focus on in the class, or what we're going to come across, that you're going to have to refer to, is standards dealing with auditing standards issued by the AICPA Auditing Standards Board, and then the PCAOB Auditing Standards, which applies to publicly held companies only. The AICPA Auditing Standards can also be applied to public entities if there are no PCAOB standards. And so the PCAOB hasn't totally revamped auditing standards, so they don't have an auditing standard for everything. And so in those instances where they don't have an auditing standards, auditors follow the AICPA auditing standards for publicly held companies. But the PCAOB standards are only applicable to public entities. Right, so we're going to see both types of standards as we go through the class. And so under those standards, right, so the standards, the GAAS, generally accepted auditing standards, right, provides a framework, basically, of what the auditor's responsibilities are, the performance of the audit, and the reporting. Right? And then under each of these areas, there will be more detailed standards. So for example, under performance deals with the conduct of the audit engagement. And so one of the things that we're going to look at next week is audit planning. Audit planning is a standard that would be, that addresses the auditor's responsibilities under the performance principle. So let's go through these in detail. So the responsibility standards deal with the standards that address auditor characteristics, what the auditor should bring to the audit engagement. And so when we talk about responsibility standards, we're talking about things such as the auditor's competence and capabilities. Right? So there's a reason that you have to have a degree in accounting. There's a reason that you're expected to have continuing professional education, right, as a CPA. That you can't go to audit a client if you've never, if you don't understand accounting and audit. So there's expectations that auditors are competent and capable to perform the job. Then there's independence, and so there are two areas of independence. So one area deals with independence in appearance, which I think we talked about this before, and then the other is independence in fact. And we'll go into more details on independence on Thursday. But independence in appearance deals with how an outside person would perceive the auditor. And independence in fact gets to the mental attitude of the auditor. So independence in appearance is easily measured, right? Because it's, did you violate the rules? So do you have stock in your company? Are you auditing a company where your spouse is the CFO? Does your spouse have significant ownership in a company that's an audit client? Right? So that's independence in appearance. It's measurable. Independence in fact is more difficult to determine. Yes.
If you're a shareholder of a company and you had to do an audit for it, but you sold your shares prior to the fact, is there a time span between?
Right, so if you sold your shares, if at the time that if it's no longer a client, right? If it wasn't a client at the time you had the shares, but by the time it becomes your client, you've sold the shares, then you're not violating your independence. Right? You can't have ownership. Or by the time, so you can have a situation. Why is it so hot in this place?
Yeah, today's hot, but usually it's cold. Today's hot, but usually it's cold here.
Oh God, it's not on the days that I'm here. Anyway, so I'm sorry. So and we'll cover this in more detail when we talk about independence, but if you're a partner in an audit firm, and in that office where there's your spouse, let's say, has ownership in that client, then you're no longer independent. Your independence is impaired, right? You can't have that. But if the shares are sold before it becomes an audit client, then your independence is not violated. But we'll talk more, we'll cover independence in more detail. Due care, right, is the expectation that you perform the audit or approach the audit with the attitude of conducting a high quality audit, right? That you are conducting an efficient and effective audit. You conduct the audit in a way that would be expected of any auditor who's conducting that audit, so that you bring due care to it. And then we talked about professional skepticism and judgment, that auditors have to approach the audit with a mindset of professional skepticism, right? And being knowledgeable about the importance of making good judgments, right? Or thinking through what kind of biases or barriers that would prevent the auditor from making good judgments. So we talked about professional judgment a great deal. So those are the responsibilities that those are the characteristics that the auditor should bring to the audit engagement, that they should possess, that's expected of the auditor. Questions?
It doesn't matter what position you are in the team.
Doesn't matter. This is required of you as the auditor. But as a CPA, as an auditor on engagement, this is your, whether it's a public company or private company, this is the expectation. It's your responsibility as an auditor. Okay. So then, as I said before, performance deals with what is expected in the conduct of an audit. So once you're on an audit engagement, what are the characteristics what are the responsibilities of the auditor on that engagement? How should that engagement be conducted? So planning and supervision. So next week, as I said, we're going to talk about what are the steps in the audit plan in preparing to audit a client. So for example, you have to know, right, do you have the expertise to audit that client? Right? Or you have to have the people that you can put on that you have to have audit team members who have the capabilities to audit that client. Right? So putting the right people on the client, making sure, for example, that you have properly assessed what the resources are that you will need for that audit engagement, right? Not only do you have the people, but do you have the ability to allocate the time necessary to conduct that audit? Supervision is, as it would suggest, right, that you can supervise the people, that because there's a hierarchy, and most, a number of you indicated that you already did internships, so you know there's a hierarchy on the audit. And so people have to be supervised at various levels in the audit. Right? And the goal with the performance principle, right, these standards or these characteristics are meant to ensure that auditors can provide reasonable assurance. Not absolute assurance, but reasonable assurance about the fairness of the financial statements, that they do not contain material mistakes. Have to be able to gather evidence. So your performance, the performance standards relate to the evidence gathering phase of the audit, from the starting of the planning of the audit, risk assessment, on down to the type of evidence. Right? So that planning and supervision. Materiality is a concept that we'll discuss in more detail in a few weeks, but materiality, right? Because think about, you're providing reasonable assurance that the financial statements do not contain a material misstatement. Well, what's material? What's material to you, Jeff?
It would depend on what the client would say material. Sometimes we put the 5,000 or whatever the range should be.
Okay, somebody else. Yes.
Falsified numbers, just misstating like the net income or something like that.
Right.
I think it should be a percentage
Could be a percentage of what?
of anything you're auditing. So it could be like an account, or it could be revenue, So it could be like, you know, a balance.
Right. So that's a method of calculating materiality, right? But the auditor has to determine what makes, so the basic definition of materiality in audit speak, right, is what would impact the decision of a reasonable user? What would influence? And that is going to be different depending on everybody sitting in this room. Right? Some people, think about when we did Rosie's Diner, right? Some of you were, look, we're not paying it, it's off by 5 cents, it's off by 7 cents, so I'm not gonna pay it until they're adjusted. Some people would say, I really don't care, but now I know I just have to audit this, you know, look at this bill a lot more carefully going forward, right? So so imagine that, something as small as that, but imagine it in the capital markets. What's gonna matter to me? I don't wanna lose any money, right? We don't wanna lose any money, but we have we have a risk tolerance. So we might be, some people might be willing to risk thousands of dollars, some people might only be willing to risk hundreds of dollars. So the auditor has no idea what everybody's risk tolerance is. So they have to come up with some type of estimate of what that risk tolerance is that could have impact overall reasonable users. And as Matt pointed out, there are methods of determining materiality. It could be a percentage of net income, it could be a percentage of revenue, it could be a percentage of total assets. And the auditor has to decide what makes the most sense given the client. Yes, Shannon?
So if you come up with like a standard for yourself on what you consider to be material, but maybe like a client doesn't agree with
It's
what-
not the client's call.
So you don't have to worry about like whether or not they're happy with it.
No, because it's not that. The materiality is an audit concept. Because this is how you're going to evaluate, right, the potential misstatements. And now the client will weigh in on it because that's what they do. They'll say, oh, that's not material. Well, the client can't make that call for the auditor. And the auditor should not be swayed. They should be based on what the auditor believes materiality is. And I won't get into a full discussion on it, but you know, that's an audit concept. Right? But clients know it. I mean, and auditors don't necessarily tell. They'll, you know, if they're trying to argue a position, they might say, well, this is material, and here's why I believe it's material, right? And the client can come back and say, well, that's not material. But at the end of the day, it's the auditor's responsibility to evaluate what they believe is material against the benchmarks that they set. And I'll just say this in number one. And it's not just based on quantitative. It's not just a quantitative. The quantitative calculation is the first step, but it's not just based on that. It's also based on other factors that the auditor considers. Risk assessment, as I said before, the audit is a risk-based audit. So when we go over risk assessment, we'll go over the PCAOB standards on risk assessment. Auditors have to assess the risk. And that risk assessment is around the framework of the audit risk model. And the audit risk model is a standard model that's used, again, it doesn't matter if it's publicly or privately held company. And the audit risk model is a model that looks at, the auditor has to assess the client's risk of material misstatement. Right? What's the risk of material misstatement? And then based on the assessment of that risk, they have to respond to it. So the auditor only controls two things in the audit risk model. They control the amount of risk they're willing to accept, meaning the amount of risk that they're willing to accept that they blow the audit opinion. So how much risk do you think that is? Very slim, right? So those, right, is low to very low. Because what happens if they blow the audit opinion?
It could look bad on like them and their firm.
Reputation. But what else?
Fines? Any fines that they?
Fines, right? Penalties.
They could lose their license.
They can pull their license if it's really egregious, right? The state can pull their license. But what else?
Could they be fired?
Oh yeah, they'll be fired. They'll be fired.
Criminal, yeah.
jail. Yeah, I don't know too many auditors who went to jail, but they could, depending on how egregious is it. I mean, come on, you did start seeing people going to jail after Enron, right? There's a much higher tolerance for jail time now than it was in the past. But what else? What do we see all the time? The outcome of a subsequent misstatement.
The firm can you can be erased. Like the firm goes down.
Well, that's really it. Okay, right. But I mean, that was the emphasis, right? That
Yeah.
it's so egregious. Well, it could have a negative, right? It could have a negative impact on the company's stock price, right? But for the litigation,
No.
right?
Yeah.
Litigation. The auditors have deep pockets, so that's why they want to keep that risk low. They're not trying to blow the audit opinion for all the reasons that you stated, right? They don't want to blow the audit opinion. So the only thing they can control is how they, in order to keep that risk low, they have to, the only thing they control is how they respond to the risk inherent in the client's environment. And the risk that's inherent in the client's environment is inherent risk and control risk. That the auditor can only assess those things. And so that's why the risk assessment process is so important in the audit. And that's what I mean by the audit is a risk-based audit. Because auditors have to assess the risk of material misstatement, and they need to get it right. Because the consequences of not getting it right means that they blow the audit opinion and they subject it to all the things that we're talking about. If they don't get it right, they're not going to respond to it appropriately, which increases the chances that they'll blow the audit opinion, that they won't uncover risk of material mistake. So we'll cover that in more detail when we talk about the audit risk model. And then finally, audit evidence, right? Because they have to gather audit evidence about the assertions that management's making regarding the financial statements. So and when we talk about management assertions, I think about a couple of weeks, maybe next week, right? Management says all of the assertions are the same. If it's public, private, it doesn't matter. They're making the same assertions. It doesn't matter what, if you're talking about revenue, the assertions are the same versus if you're talking about acquisitions, right, or expenditures. The difference is the audit evidence that the auditor collects to respond to that assertion, to get evidence about that assertion. So management made an assertion that revenue is valid. It occurred. That's what we call the assertion occurrence, right? That is valid, or that accounts receivable exist. So the accounts receivable that we recorded at 12/31 in the balance sheet, they exist. That these people, we really are owed this money, right? So auditors are going to get audit evidence regarding that. What's in the balance sheet or what's in the income statement about the assertions that management makes. And so when I talked about the audit risk assessment, and I talked about the auditor's response to the client's risk, that's what we call detection risk. And auditors are concerned. The auditors want to design their audit approach so that they gather audit evidence that would uncover or detect a material misstatement. That's what we mean by detection risk. That their audit procedures are designed in such a way that it will detect a material misstatement. So they want to keep the risk low that they won't detect it. So they want this risk to be low, that they won't detect it. And they design those audit procedures so that they address the appropriateness of the audit evidence and the sufficiency of the audit evidence. And so appropriateness deals with the quality of the audit evidence, and it speaks to relevance and reliability. And sufficiency deals with the quantity of audit evidence, the amount of evidence that they need to collect. Right? So relevance tells us that it is, right? What does the evidence tell the auditor? So if I'm gathering evidence about the assertion related to occurrence for revenue, I'm not going to look at checks I'm not going to look at cash disbursements, right? Because that's not going to tell me anything about revenue. First of all, it's a disbursement. Revenue means I should be receiving cash. So that cash disbursements might be good evidence, but it's not relevant evidence to test that particular assertion. Reliability says that the auditor can trust the evidence, that it's coming from a reliable source. And part of that is that the person who's providing that evidence is capable and have the expertise and the knowledge to provide that evidence. So that's why, and this becomes really, professional skepticism is important in these two cases, right? To be able to detect information or evidence is, determine that evidence is relevant and that it's reliable. So we're going to actually get into this more next week, the different types of audit evidence that auditors gather. And part of that audit evidence also includes client inquiry, so asking the client questions. So that's performance, right? So performance, again, is what the auditor brings, what the responsibilities of the auditor are for the audit engagement, in performing the audit engagement. And then finally, there are the principles of reporting. And reporting deals with the standards around the audit report. Under what circumstances and scenarios does an auditor issue different types of reports? So the first type of report, right? What type of an opinion? So the audit opinion is standard. So when you pick up an audit opinion and it says that the client received a clean opinion, so that it's unqualified or unmodified, it's in accordance with the audit, the client, there are no material misstatements, and the client records their transactions in accordance with generally accepted accounting principles, GAAP. Right, the reporting framework. That's a clean opinion. So when you pick that opinion up and you read it, it means the same thing for every client that the audit report that you read, that it means the same thing because we have these standards of reporting of what constitutes, what we mean by a clean opinion. And so everything that we're gonna look at when we talk about audit reports, we're gonna look at, well, what happens when you pivot away from an unmodified opinion? What circumstances result in you issuing something other than an unqualified or unmodified opinion, which we generally probably hear called a clean opinion, right? So there are different types of opinions. Qualified opinion is also referred to as an except for opinion. And actually somebody just sent me an email asking me if I had any examples of real life, real world qualified opinions issued because they couldn't find any. And that's because it's not that there are no qualified opinions out there, it does exist. But for publicly held companies, they're not allowed to get a qualified opinion. The SEC does not accept that. So companies that have to file a 10K, right, that's an issue. So it's rare, is what I'm trying to say, it's rare. I can't speak to privately held companies because those financial statements are not public, right? We don't get access to those. So it is rare, but the reporting standards or framework it drives, well, when would you issue? What's the situation when we would issue a qualified or an except for opinion? And basically what a qualified or except for opinion is that everything is okay except for this. So let's say, for example, the auditor, the client followed some different reporting standard to report inventory. And so these would have to be material. If it's immaterial, you can just issue a clean opinion. But let's just say, and the auditor reviewed it and said, okay, it makes sense given their business that this is more reflective than GAAP would be for the economic substance of their inventory transactions, right? So the auditor determined that, but it's still, you can't now conclude that it's in accordance with GAAP. So the audit report would refer to that, would say everything's okay except for, and refer to the qualification. So that's why we call it an except for opinion. An adverse opinion is the worst, right? It's bad. Right, because it says there are material misstatements, not in accordance with GAAP, and so forth, everything, there's just a problem, right? So then the standards there list all of the situations that would give rise to an adverse opinion. And then finally, a disclaimer of opinion is just what it suggests. You can't give an opinion. You were hired to audit the financial statements, but you couldn't audit the financial statements, and so therefore you can't give an opinion. And those are usually because you're usually issuing a disclaimer of opinion because there are significant scope limitations that you were not able to gather audit evidence. And so you give you can't say that it's not in accordance because you had no evidence to evaluate it. That's the difference, right? The adverse opinion, you can give an adverse opinion because you gathered evidence and that you evaluated that evidence, and that evidence told you that they're not in accordance with generally accepted accounting principles. So therefore, then we can't conclude that it is a clean opinion, right? So you got evidence. Disclaimer means you couldn't gather evidence, so you have no basis to form an opinion. So we'll go into those again in more detail when we talk about the audit report at the end of the semester. Yes, Stephanie.
What do you mean by like the public company can't get a qualified report? So like
Well-
what happened?
Well, so I shouldn't say, the SEC doesn't accept it, right? So you're now in violation.
So like do you do it over again or?
Well, you make, so there's the pressure on you to make sure you do it right? So you wouldn't, so the example I gave, right, would be, and I'm not saying it was never ever.
Yeah.
I just, it's rare for publicly held companies because of the challenges. Because it's a restriction, SEC doesn't accept it. So the example I gave, a publicly held company, right, would probably not, select an inventory reporting method or costing method that's outside the GAAP. And if they did, they would already go to the SEC,
Okay.
right? Beforehand, they would say, well, this is what, and here's why. They would already have gone through all of these things that they need to get the SEC to buy off on it before they even try to issue their financial statements.
Okay.
Right, but it's just, and there have been publicly held companies that I just would not be able to go online right now and Google it and find one. Because, and I had never really thought about it because I'm teaching it. Like every opinion that, every audit that I was ever involved in, I never encountered a qualified audit opinion for a publicly held company. And actually not even for any of my privately held audits that I did. I just never encountered one. I just know about it because, or disclaimer, So, it's hard to find. And the only reason I brought that up is because someone just last week sent an email saying, oh, Helen, do you have their students, his student asked him if he had an example of a qualified opinion that had been issued for a publicly held company. And he did the search and he couldn't find it. And he says, oh, do you have an example? I was like, I never really thought about it, but no, I don't. So, but that's why it's so rare that you see them. So, but beyond it, despite all the things that we hear about, audit failures and so forth, the overwhelming majority of audit opinions are clean audit opinions, unqualified audit opinions, especially for publicly held companies. And that's the only basis we have to go on too, because we don't have access to private audit reports for privately, or financial statements for privately held companies. All right, so the other aspect of the standards deals with just the firm, right? So the quality control system that the firm has in place to ensure that their audits are conducted in accordance with GAAS, that their auditors meet the requirements under the generally accepted auditing standards with respect to independence, competence, that the audits are conducted with due care. So this is the internal controls, for just looking at it a little bit differently, that the firm has in place to ensure that. So, for example, it's the auditor's responsibility to make sure that they're independent, right? But audit firms will make sure that their auditors know that you have to be independent, so they have to self-report. And Ivy was saying in the last class that when she was at Ernst & Young, they self-reported their independence from clients on a quarterly basis, right? And it's a standard process, forms that they have to fill out, and she said it took like 30 minutes
to go on.
to do, which if you're, busy, is a lot, right? And so I think, was it Walker or was it maybe someone said that you had to do independence, I can't remember if it was my other class, right, for your engagements, right? So the firms, make sure, like they make sure that you're independent, like you have thought about this, you need to think about it, make sure that you're not, right, impairing your independence. So to ensure that the people comply with the professional standards as well as, regulatory and legal requirements. And then also dealing with the reporting, right? Because remember, the audit opinion may be signed by the partner, but the partner's name is not on the audit opinion. The audit firm's name appears on the audit opinion. So it has to be, the firm has to ensure that all of the audit engagements comply with the reporting standards, which is why you have a technical partner review as well, to make sure that the audit engagement team is issuing an opinion, right, in accordance with the requirements or the standards of the reporting, what constitutes a clean opinion. That you can, that your audit evidence supports the opinion that they're given. The other thing that, like another example of firm quality control standards would be the internal review. So we know that for Big Four firms or even the second level 4 firms, right, as long as they have publicly held clients, they audit publicly held clients, that the PCOB is going to come in and audit them or evaluate audits on a risk-based approach. But the firm, it doesn't stop there because the firm also has privately held companies, right? So they do their own internal quality control check. So that's the oversight. Right? So the oversight, so firm has their own internal oversight, but then we know that for publicly held companies, there's the PCOB, and the PCOB has an inspection program, which they go in and they monitor the audits. The audits are selected based on a risk. They take a risk-based approach to auditing, to the audits that they select. So they're going to always look at those clients that are higher risk. And the higher risk could be based on things that we've already discussed, such as the complexity of the audit client, the audit engagement, size, meaning, if it's a multinational company, it's going to just be complex by that fact. Right, so they're going to always pick those larger, more risky clients. Depending on the size, so all of the Big Four firms are going to be audited all the time, right? The PCOB is in there all the time because the majority of publicly held companies are audited by the Big Four. But the second 4, the smaller public accounting firms that have public clients may not be audited as regularly.
Is there a difference being either in PCOB and one of the Big Fours?
So when you say one of the Big Fours, what do you mean?
Being an auditor in one of the Big Fours?
Oh, versus
the
being an
PCOB.
auditor in PCOB? Oh, yeah.
So what are the different requirements or anything?
Well, not necessarily. So the PCOB will probably hire people who have, like I've met some of the people who are inspectors of PCOB, they have public accounting experience. They might have been in the Big Four. Like they've done a wholesale change of their top team, but like the chief inspector was a former partner at one of the Big Four firms. So their focus is different, obviously, but most of those, you have to have audit experience. They do, I think they also have people on there that might have legal experience as well, but for the most part, most of these people are former auditors, I would say. Yes, they were.
Was this only something that was around after the Enron scandal? Because why do they PCOB audit on their?
Right. So so that leads me down to this AICPA, Center for Public Company Audit Reviews, right? So the PCOB is a direct outcome of the audit failures, Sarbanes-Oxley, right? And so after Enron, WorldCom, and those big scandals, and Sarbanes-Oxley was enacted, the audit profession lost the ability to regulate themselves. Prior to this, they basically were self-regulated. And for publicly held companies, you always had the SEC, they always had the SEC oversight. But the SEC didn't go in and inspect audit firms. It was if they saw something was a problem, then they would, if they saw a filing and they're like, there's a problem with this filing, or we question something, then they could go in and inspect the audit program. So it was no formal inspection process. So prior to Nayland's question, prior to the PCOB, firms were a part of the AICPA's oversight, their peer review program, right? And so the peer review program, and the way it worked, and I think it continues to work that way, is let's say I'm, KPMG, and my counterpart, Arthur Young, Ernst & Young, I'm dating myself. So Ernst & Young will come in and randomly select audit engagements, and they'll perform a peer review. So there was a firm, across the firms, they would perform peer reviews. And it was usually driven by the size, right? So the Big Four would audit the Big Four or do peer reviews of the Big Four. Small firms would do peer reviews of small firms. And so they would not just focus on publicly held clients, they would just select a sample of engagements and go in. And so, but the firms also had their own internal review, right? So they still do this. So if I'm in the New York office, someone from national would select people, say from Chicago's office, to come in and look at some engagements out of the New York office and vice versa. So they would do their own internal peer review. That's a part of their quality control program. So firms have always had, inspections, but the difference with the PCOB is it's regulated, right? So it has teeth. It really does. I mean, with the peer review program, it was more informative. The AICPA, I don't think they didn't sanction them if the peer review came back bad. But here the peer review comes back bad. Not the peer review, but the inspection comes back bad. There's a cost to the audit firm. There's a consequence.
And isn't that also kind of the role of internal audit advisor to audit the auditors?
Well, I don't know that the firm, so I don't know how, normally the way the firm, my understanding was the firm sets up, it's a program that's conducted at the national level. And so it's not necessarily the internal auditors would go. So the internal auditors might audit the quality control system, but I don't know. I wasn't aware of that. But I think that normally it's a program that's run out of national. They'll select a team to go out and conduct peer reviews. I don't know how much they do. Well, they should still do it. But what happens though? The difference now, though, our audit teams are inundated. So if you are on, a large client, publicly held company that's probably going to get selected by the PCOB, I doubt that your audit team is going to go out and look at it, right? Because when do you do? It's just a lot. Because the PCOB. I don't know, you were in IT, right? So I don't know, did you ever have to go through a PCOB?
Yep, we had one client. Mm-hmm. And we also had internal, a team called the AQR, it's internal quality review team.
Oh, okay.
So they always have wind of which accounts are subjected to PCOB most probably. So they will let us know, and we would go through an internal review before we go through PCOB as well.
So that might be what you're getting to, Nathan. It's not this internal audit. What did you call it?
It's quality. It's a quality review team in the
team.
Yeah.
And so that's what I was saying. The team is experiencing a lot because they're trying to guess. Because they don't know. Well, you remember there was that scandal recently, right, with KPMG, where they would get inside information
Yes.
about,
Yeah.
not a good look, right? About the PCOB inspections. Because that just shows you, so here you have a firm who this whole idea, what do we talk about? Ethics, independent, if your client was getting inside information and trading on it, you would report them. So here we have that, so this is how crazy the inspection process made firms. Now, I don't know if other firms are doing it and they just didn't get caught, but you said probably. You're skeptical. But KPMG did because they wanted because you don't know. You can only guess which firms are, which audit engagements are going to be selected because it's risk-based, right?
Yeah, I think you can be able to calculate it because I think one of the factors is the partner, a new partner on the engagement, right? Because that would be like if they're like just recently promoted, they may not have enough experience, so they would be high. That would be high risk. Also, the client themselves, have they had restatements in the past year? So
there's some
they're
factors
major. Yeah, so it's not like
that.
something that's we're waiting for someone to whisper in our ears. We could actually calculate and determine which particular
But it's
engagements
still
are more high risk.
It's a risk.
Yeah.
You're doing a risk assessment
exactly.
of whether or not you're going to be selected for PCOB inspection, right? That's what they're doing because you don't know.
Yeah,
If
exactly.
you think you are, so what do these auditors then do? Like they.
So they're going to go in, right? So remember I talked about that quality control. So those internal audit, what is it? Internal audit
Quality,
review team.
Yeah.
They're going to go in and make sure that the audit, they're going to shake it up, make sure that.
That's after the audit.
Right, because they're looking at a completed audit engagement,
Okay.
right? They're looking at completed audit engagement.
Edit step.
Right, because the audit firm has already issued an audit report,
Okay.
right? An audit opinion. So they're looking at completed audit engagements and they're trying to say, okay, can you support? So they're gonna be looking at those things that are risky, okay? So usually they're gonna look at things like judgments, like estimates, especially if it's clients who have a lot of fair value, because those areas, the revenue, they're gonna always look at revenue. And so if internal controls, because publicly held clients are responsible for evaluating internal controls. And so what they're looking for is the opinion, can you support the opinion you gave with the evidence that you collected in these areas? So that's what, and so they're going, and the other thing they're looking for is documentation. Did you is your documentation sufficient and appropriate to support the opinion? Right? Did you document it? Did you document your rationale? So, Ivy could probably tell you a bit more what they look at. I've never gone through one of those reviews, but I could, just based on what the PCOB is looking at, they're looking at those higher risk areas. So firms are getting it now. The biggest thing for them was that they were once able to regulate themselves through this whole and be a part of the AICPA, peer review program, and that was it. But now they're dealing with the PCOB, who is in there. So I put a link. So the PCOB lists, their reports are public information, right? So you could go on and just get an idea if you're interested to see what that PCOB report looks like, what are some of the deficiencies that they're listing. And the PCOB will talk, like I remember when they were focused on the fair value measurement, they talked a lot about professional skepticism. Like they felt like auditors weren't skeptical enough. Right? The reason they concluded that was because they felt as though, their assessment was that for these very subjective accounting transactions, that auditors were not requiring enough evidence, right? That the evidence didn't support the opinion that they gave. That they didn't feel that the auditor challenged the client enough on it, or that the auditor tended to accept especially if the report was coming from a third-party specialist, that the auditor tended to accept it without really reviewing, getting a complete understanding of the inputs and the assumptions and so forth and that. And so they talked a lot about professional skepticism because of what the PCOB was seeing in these inspections around fair value measurement. There's now a whole, there was new standards on auditing fair value measurements, right? And now I don't know if the standard has been finalized yet, but background check, but now a standard on the use of specialists and audit engagements, right? So the PCOB, so the risk assessment standard, right? They, after everything, their inspections and the rollback from Enron and WorldCom, that's how we ended up with a whole new suite of risk assessment standards issued by the PCOB. So there are consequences or results of these PCOB inspection reports. Let's look at a problem. Let's do a problem. Problem 264, which is it's dealing with the general accepted auditing standards, and it starts on page 69.
In the textbook?
Yes, in the textbook. And 269 and ends on 70.